symbol, meaning, so it's not tied to the VIX. Let's go over to a trade table. And notice, let me get my zoom up here. Here, I'm just randomly picking some ticker here. Here's the March 28, here's the April 4. So these are weeklies. This is this Friday, next Friday, the Friday after that, the monthly on April the 17th. Here on Tasty, they do it based on, they show you the number of days. But what I want to point out is over here on the right-hand column, 67% implied volatility. And on this particular ticker there, I don't even know which ticker I'm on, but they're showing plus or minus like 25 cents, plus or minus 42 cents, and so on. So this implied volatility, what it does is it's the market basically saying that because of time and because of recent price action and news and all kinds of stuff like that, there's a certain degree of unknown. Actually, let me get over here to a ticker that actually has something worth notable in it. Let's just pick TNA. Again, same thing here. We got each Friday coming up. But if I come over here, see this implied volatility? 74%, 77%, 78%. So this is the market makers basically saying that, again, because of the news, because of whatever it may be, and because of time, there's a certain degree of unknown what's going to happen to the price of the stock between now and the end of day when this expires. They show it as this IV, the implied volatility, and then they give you a dollar amount. So if we go look here at TNA, is currently at $33.37. They're saying that by Friday, this can move plus or minus $1.65. Okay. Now, that's not, that's not guaranteed. That's just where they think it's going to go. And so a lot of trading will be based. This is one of the nice things about Tasty Trade. Here is that. Let me zoom in on that. I'm looking at these options for this coming Friday, which they said plus or minus $1.65. Here is that range. They show it right here. So I'll come back to that when it's my turn to talk more. Cavatha, Cavatha cannot hear me. Jeremy, can you hear me?
Loud and clear. Let's see here. Let me pull up the chat on my other screen here.
Oh, she says it's okay now. Okay.
Okay.
All right, good. All right. I just happened to look over there at my screen and see that. So now let me pull up my little diagram. When we are looking at a stock, and notice this is not about ETFs because ETFs do not have earnings. ETFs do not have earnings. The stocks within the ETF may have earnings. And if you're looking at a ETF that only has one stock in it, like MSTU or NVDX, SOXL, SOXS, these are ETFs, but they only have one stock in them. As a result, they can be a little more volatile. But when we talk about just a pure stock like GE, Boeing, NVIDIA, Tesla, these kind of names, they have earnings. And when that earnings happens, tie in to the wheel trade. So I've got implied volatility on the y-axis. I've got the date on the x-axis. As we start getting towards that earnings date, which is the red line, we have this unknown about what's going to happen to the price of that stock as we get close to that earnings announcement. So the price of the options start to go up. And that is because the implied volatility starts to go up. The uncertainty factor is going up and up. And because the uncertainty factor is going up, the price of the options is also, the IV is going up, the options are going up. Then the earnings announcement happens. And now there's no more unknown. The announcement is made and we know everything, and the price of and the IV and the options plummet. This is called IV crush. Now, what that means, therefore, is always have your eye on an earnings date. So let's just say that we get into an option here. Maybe we're doing the wheel trade, and we are thinking about selling a cash secured put. We're looking to get into this trade. Well, let's say it's that put is 30 cents here, then it's 50 cents, then it's 80 cents. Here it's $1, here it's $1.20. Earnings happens, blam! All of a sudden, the option price crushes.
That's my favorite scenario right there.
Now, the other thing to remember, though, is that because you're doing a cash secured put, because we're going short on that option, we sold to open, STO, is that theta is eating away at the price of the option. So while implied volatility is going up, theta is actually crushing it. And what we see is, well, where's my pen, dadgummit? I've lost my, oh, what, no? Well, what the hell? Oh, home, there it is. There we go. So theta is suppressing the option price. Let's go with the orange. And so the cost of our option, however, is on one hand, it's the price is going up, but on the other hand, the theta is crushing it. And so we kind of see this, and then we see this. Now, what's going on here? The price of the overall options are going up, but if you sold your option right about here, for example, now, and I'll mention this here, but we'll call this point A. You sold your option here. Notice you didn't make a lot of money. Price is also down here, just like IV. So you didn't make a lot of money, but maybe the price is going against you here, or so it seems, as the option price is going up. But if you're going to ride this out to expiration, this is going to come down to zero. So if you're playing earnings, where you want to sell is somewhere in this sweet spot, like B, possibly, and then get the hell out of it right before the earnings, unless you're willing to take it. Take the stock. If you're willing to take the stock, then you know that because for whatever reason, price could continue to go up. But from the option standpoint, you can get more money out of it, but then it'll crush. And then you can either take the stock or close your put out and just pocket the money possibly. But a lot of it has to do with which way the price of the symbol of the ticker goes. So earnings is a really tricky thing to do. Earnings very tricky. Because you can experience an options crush, which is wonderful if you can sell it near the peak. But if the earnings turns the other way and the price of the ticker starts coming down and rockets down towards the ground, then you're going to get assigned. And unless you put a stop on it to get yourself out of it. So, this is a great place to trade right here as you get closer to the date as far as selling and collecting premium. But you've got to decide what you're going to do right here. You must have a plan, what you're going to do 10 minutes and know exactly what your move is going to be 10 minutes before that earnings announcement comes out. You either get out of the trade or you're willing to ride it again or whatever. So you must have a plan on what to do here, because if the price goes way down here, yeah, you collected some great premium, but you may be grossly underwater in price, depending on the earnings. So I do not hold through earnings personally. Jeremy may or may not, that he'll talk about that. I do not, because I don't want, if this thing was going for $100 a share and then it drops down to $89, I don't want it. If I did my cash secured put at 100 and then that thing drops down to 89, I don't want it at 89. That's me. I get out of it. I do not hold through earnings. But a lot of times you can catch, if you can get in the sweet spot, there is a place where you can get in somewhere between here and A and B, where theta will work faster than the uncertainty than the IV. And you just got to spend a little time learning that. Any rate, Jeremy, any thoughts, comments you want to make on that? You got any drawings you want to throw up there? My drawing here looks like some kind of spaghetti or something, but anyway,
looks like a play.
Oops.
I mean, like there's a line of scrimmage,
anyway,
and you got your your running back going deep. Your right guard's hooking half over there to distract people, and then the other half is chasing the runner. Yeah, you're good.
I'm just saying there's a lot of, we don't know what's going to happen with the earnings call, and you need to have a plan on what are you going to do with that. And when we are coming into earnings season. So if I look at like my symbols over here that I'm following, see how many of these got earnings coming up? All right, I got quite a few with earnings coming up in here. And in fact, my fault, I took this trade on Dollar Tree and then realized the stupid thing has earnings on Wednesday of this week. And I was like, oh God.
So you missed out on the implied volatility hike. So
and I probably wouldn't have taken this trade.
I do try to take consideration of earnings plays, but I also like to go further out of the money and try and achieve somewhere just slightly above my average premium per option I sell, whether it's a call or a put. And ideally, if
you want to share your screen, can you do that and still keep all the recordings going?
Yeah, I'm actually just relaying your screen to the recording. So in actuality, and this might be an adaptive thing to do, what I might do, since you have a better display for options with Tasty Trade there than I don't have a Tasty Trade account.
That's fine.
I might relay tickers to you. Right.
Yeah.
So currently I can share my positions, and With TNA, currently I'm just long equity and
All right.
sitting tight.
So let's take a look at TNA direction. Yeah, okay, it did switch. All right, what strike do you want to look at? Or expiry?
So if I'm looking right now, I want to go 2 weeks out typically with TNA just because things
All
are
right. So that'll be April the 4th, which
Correct.
is 11 days out. And let's notice over here, 2 weeks out, 77%, $3.04 is the expected move.
That's right. And
So let me just show you, let me explain what we're seeing here in case you're not familiar with Tasty. Real quick here. You have, like most things, you have your calls on the left, puts on the right. This darker, or excuse me, this shaded area here is in the monies versus on the calls, this is in the monies. Price is right about here. This is your at the money. And Tasty gives you this kind of orange line right here showing you the expected move
kind of liking
for
that.
the next 2 weeks. This line up here is a standard deviation line. And you'll notice there's one above and one below. When we look at the delta, delta can be also thought of as the probability that it will hit and end in that area, roughly. So here we have a delta 11, forget the negative sign. So
Yeah.
here we have a delta 11. So in theory, that means there's an 11% chance that this will close at the end of expiration at or below $28. So that's, roughly an 89% chance that if you were to sell this option here for $27, that you would pocket that money. All right, Jeremy, please, with that being done, continue, please.
So where I'd be looking right now is if I
Do we
want
wanna look
to,
Do we want to look at the chart or we want to look at the option chain?
kind of both. So first,
Okay.
we can look at the options chain. So if I see that sweet spot just on the options chain, that 3150 strike is about where I want to be if I wanted to get in a position there.
Okay, inside the expected range.
My cost basis, if I were assigned on that, because it's receiving $1 premium there or more, would be 30.50. So I'd be putting myself right at the edge of that orange, close.
So let's back up and explain that real quick here. Jeremy is saying that if price closes below $31.50, he will get assigned 100 shares, which will be $3,150 because it's times 100. However, because he got $102, remember, options are times 100. Because he got $102, that would reduce this price, we'll just call it 100, to $3,050. Subtract $1 from this, which would put his price, that his basis, down here at around a little over $30. Does that make sense to everybody? Okay, Jeremy, I'm sorry to interrupt you. I'm just trying to explain the mechanics as we go.
This is actually better because I tend to not have I get into the weeds a little bit on the details sometimes, and you're being very very forward with it. So I think that this works out better. Right.
All right. Now, why would you take this trade when it's in the expected range? It does have a roughly 70% chance of probability of you pocketing that $100. So you've got about a 30% chance that it's going to go in the money and you'll have to take the stock.
Correct.
Tell us about that. Why this strike?
2 reasons. One for me, I'm already long equity. So at the same time I'm selling that cash secured put, I'm going to be looking for a covered call to sell as well.
All right. If you're flat, would you take this? Would you still take this line?
If I'm flat, I would probably take that line, although I might consider the 31 strike because I
Okay.
know I can get a little bit better cost basis on that from assignment than I can from the
Sure.
3150.
Sure. And that's a good point. Look at the difference in cost here. This is at roughly $1. This is roughly 85. Let's call that about a 15-cent spread. But there's a 50-cent spread here. So am I losing that much to drop back? No, actually, I am not losing, because you would think if you move from here to here should be a 50-cent drop. No, this drops 50 cents, but this only drops about 15 cents.
Correct.
So this is a really good line to go in as well. What are your thoughts about this volume and open interest? Does that catch your eye in any way?
It does. It's almost dead even. So the volume today has traded open interest, meaning it's traded at least as many contracts that have been issued. And open interest is a two-way street. It shows how many contracts exist in current time. That's saying that currently there have been 156 of these contracts written. And if they're sold to open, they're written by the person who sold to open, and whether it's a market maker or a trader or an institution, doesn't matter. The other part of this is, and you don't get to see the original open interest or how much the average was days before in this chart, but you got to realize anytime a position is bought to close after having been sold to open, that open interest goes down by that amount, that contract. So open interest will change.
Let me inject on that real quick, the difference between open interest and volume. When the market opened at 9:30 this morning, they look back from yesterday and before and find out how many options are still on the books, open trades on this 31 strike for this expiration. So they're saying that 156 contracts were carried over from yesterday, open trades. That's what open interest is. Open interest will not change today. It is what it was at the market open at 9:30. It will not adjust until again tomorrow at 9:30. That's important to understand. This number does not change during the day. Volume, however, is the intraday changes. The other thing to understand, so this is as of 9:30 this morning. This is what's happened since 9:30 this morning. But the one thing to understand about these numbers, they do not tell you whether people are going long or going short. They do not tell you that. This could be 156 people that had gone short. Now, obviously, it's probably a mixture, but you have to remember that just because this is on the put side does not necessarily mean that all these people bought puts. Some people could have sold puts, which is what we do when we're doing the wheel trade here with cash secured puts. Same thing with the volume. Doesn't tell us whether they bought to open going long or sold to open going short. It just tells us it's a very active and very well liked price. That's all it tells us.
Correct.
All right.
So,
okay, Jeremy, please continue. I apologize.
Oh, it's okay. So since I'm already long interest or long equity, I'm also going to weigh this against my current cost basis. So if I were to be assigned on this, I want to know what the cost basis would be on the assigned shares. So we want to deduct the premium that we received from selling to open that particular strike versus what my current cost basis is. And this would reduce my current front cost basis quite a bit. But remember, I've been trading this for over a year now. So my over the year is still well below this. I'm still, about $16.48. So I wouldn't mind taking possession of more shares at that price. It would increase my overall cost basis, but it would decrease my current cost basis, which is actually a bit underwater. I'm at 41.62 on that. An adaptation to dealing with this drawdown and realizing that the previous low is more important, and that was currently 28.40. So during the time where it came back above $30, I did something to take advantage of a short-term swing with something that's intrinsic. So this is kind of going to go a little bit beyond the beginner scope of this strategy and give you an idea of what you can do if you're underwater a bit and yet you find that price is reversing, at least in the short term. And what you'll want to do is two things. You can go and hedge your risk with a collar strategy, which is a little bit more complex, or there's a much more simple way if you believe that the price is going to come back up to at least some sort of return, whether it's a half back on a previous trend or what have you, with whatever you believe in with price action or whatever you understand with price action. Let's go to the furthest expiration date that we can find. So January 15th, 27 there. And on the call side, let's look at the data for the 30 strike. And here's the fun part, and there's two things here. Notice how the market makers don't issue anything below $20 in this range. So probably not expecting this to be and very much lower than $10 down from current price at 30-ish. But if you look at the cost of that premium on there, you can acquire a long position, a synthetic long position of 100 shares per contract at the well, it'd have to be somewhere between the bid and the ask. So current ask is $12.50. I think the last trade was probably $11.60 or $11.70, somewhere in that neighborhood, just eyeballing it. And what I did when price was reversing and I was convinced that the trend was going to begin above 30, I went ahead and purchased those at 10.40. What this does is it gives me the difference between that time and whenever this trend ends in intrinsic value.
Now, you say purchase. That was a buy to open on the ask?
Correct. I added.
You bought a call.
Yep, I added calls to equal my position size long equity so that I could take advantage of short-term volatility. Even though I'm underwater on my front side, this will give me a little bit of extra premium that I can actually trade. And the idea is, look at the theta on those. The theta is super low. They're way, way, way out in time. And one advantage, there you go, the second one, that one, there you go. So if you look at the theta,
Okay.
at the
74 cents a day.
at the 30 strike,
Oh, whoa.
yeah,
16.9, call it 70 cents a day.
correct. Comparatively, it's a lot lower there than it would be on a front week or a front month or anything like that. So I went way the heck out there just to take advantage of a short-term swing. Why the heck would anybody do that with something that expires so far down the road when you only need about a month? This gives me the...
Second, I'll be right back.
Sure.
Go ahead and talk.
What this would do is it gives me the opportunity, if things ran really, really quickly, let's say price ran to like, $38 today from out of nowhere. At the moment, I have the option to either liquidate those long calls or I can begin a synthetic position with a much lower cost basis.
Okay, I'm back. My RoboVac was going off, and I knew it was going to come right to me and make that racket. And I'm like,
all right,
stupid thing.
So the other part of this is this gives me an opportunity to run a synthetic long position per contract parallel to my existing wheel trade and generating more premium without really a lot of risk. As opposed to, having to have $3,000 per 100 shares to sell extra covered calls on, I can just have a synthetic position for what I paid was $1,040 per contract. So
a little bit more of an advanced strategy, but the idea here, folks, simply is he's hedging.
correct.
He's hedging, and hedging confuses a lot of people. Hedging just simply means taking a trade on the other side that has it's not going to nullify one side versus the other, but it softens the blow if you're wrong. It softens the blow if you're wrong, and that's what hedging does. So when we talk about the SPY dropping 10%, well, people might have hedged that by buying some puts against the SPY. And as the market drops, 1%, 2%, 3%, their puts are gaining a little bit of money, even though their longs are losing money. But the idea is they're still long. Now, in this case, we're actually flipping it, because instead of buying puts, Jeremy bought a call, because if the market goes up, the call will offset some of the losses that he's had with his with the value. He said he's a little bit underwater on the TNA, on his cost basis with TNA. The stock prices have gone temporarily the wrong way against him, and it's transitory. But so he's using this call basically to offset. Now, if the markets should just take off like a rocket, and his stock prices get so far out of bounds that it's hard for him to do something or whatever, those calls will make money and offset the fact that his being underwater is, he won't go deep underwater. He'll go a little bit more underwater. And then over time, the expectation is that the price will turn around and come back down to his cost basis, and then he can dump these calls.
Correct.
So anyway.
And I'm also considering, I could dump them right now and just get rid of the synthetic long position and take $1 off my cost basis immediately. So I can choose to do that, or I can choose to sell diagonals, where I would go and probably sell July or October expiration calls against this, as long as they are more than my cost basis should I have to take and be called away on the short strike versus my cost basis of break even on the long strike. So since I paid $10.40 for these, that's $40.40 cost basis. Add the 10 to the 30 strike, or add the 10.40 to the 30 strike. So it's way out there. I would have to sell something like a 41 or 42 strike call to really make anything on that that's worth doing. So the reason why I'm bringing this up is because I'm making a decision in moments. If price doesn't continue to go up today, and if I also reflect that this is costing me an average of 69 cents a day to hold this position open, I need to make that decision pretty quickly. Currently, I'm watching the 5-minute chart, and price looks like it's going to push back up, at least to the high of today, which is about 33.80. And that would put that contract probably close to about $11.80. So I'd make $1.40 on that just by rolling that off today. That premium that I make in liquidating that position or trading that position can be directly reduced off the cost basis that I currently hold on my front side and my overall. So it's hedging for volatility in a recent time, so that if it went lower, it wasn't going to kill me too much. If it went higher, I could take advantage of the swing and still keep my original wheel trade position, at least generating some income. at some point, you end up where if you are underwater a bit, sometimes you'll have to pause and look for the best opportunities to make premium without threatening being assigned on something that will end up causing you to lose money on the trade. That's the whole point of this.
Okay. So let's take a look at the chart then and see why you justified this trade, if that's okay with you.
Sure, absolutely.
All right. I'm on the daily 3-month. I've got Bollinger Bands and I've got an SDC, but I can certainly take these indicators off if they're confusing to you.
Oh, that's fine.
And DeMarks. So this is the daily candle of TNA. Where do you want to go with this?
So if you look at the point where it dipped down to that 28 and whatever, it was 28 something low, there you go.
28.5.
And you look at the previous group of candles to the left there, you'll see that they averaged right around $30.
Let me go to, now this is one thing that Tasty is not a good charting platform in that regard there. So let me go to a weekly or a 5-day candle. Well, hang on. What? Hang on. Crap. Let me get, where's Trading View? I've lost it. There it is. Let me get Trading View up here. 1 second. Tasty is horrible for charting. TNA. And let's go to a daily candle. Okay. Trading View is a great charting platform. It's not, I can't stand it as a trading platform, but all right. We were looking at the 28.5. So let me throw a line in there. Roughly around the 28.5. So there's my line. And if we go back, all right, here we are back in November.
So it's a pretty basic support area, and it did almost touch it, and then it came back through. So I'm expecting probably a push to about $34 is the idea. So that's still well below my
halfback would put it around 37.5.
for that whole leg long term, yes. But for the short term, about half of the second leg would be about $34 or so. So
okay.
I'm hedging short term risk because we could very well break back down in that 34 range and test the 28 again. We don't know what's going to happen. We don't know if suddenly the Iranians launch a nuke or something. Who knows? The point is, we're in a very news risk environment, and I couldn't fathom putting any more positions on without reevaluating my original risk. I still have profit in this trade that I want to keep and defend. So in short term, it was more prudent to go ahead and swing trade something way out in existence, which gives me the option to use that as a synthetic long position that I can parallel wheel trade with my current position. So I could sell covered calls against those long calls and diagonal them. The idea is I think I'm going to cash them in and take the premium against my current position so I can bring my cost basis down.
Now, if we get back up, you said your cost basis is in the low 40s, right?
Yeah, it's 41.62.
Okay. So now here's another thing to understand. Let me pop over to an options chart real quick. Remember that, and let's go back. Let's just look at the April monthlies. If we're expecting price, I want you to see that, over here on the call side, for the existing trades that he has, he can get, if we get up to around 37, this is not enough yet, but I'm trying to illustrate the point that if you sold that covered call, call it $1, it would actually mean that you would make $1 and it'd be as if you sold them at 38.
Correct.
And you say, what? Now let's go back and look at the chart. So his cost basis is right around here, very close to this volume profile. Very close to this volume profile. If he can get close enough in here that the price can come up to around here, he may be able to sell a covered call that the premium would be enough to get him completely break even back up to here. That when you take the value that he sells the stock for plus the premium that he gets for it, can get him completely back up to here. Because it's not where the stock is now, it's what the option chain premium is. Let's go back and look at that again. Like right now, the at the monies are around plus $2. So if he can get up to around 41 plus $2 premium would make the trade equivalent to 43. And he could be out of that trade completely even.
Correct.
All right. So that's something to understand about managing your options, you know, and when we're talking about selling premium. You got to remember, selling premium is quite different than buying an option. You know, we say here, well, I think it's going to go here, so I'm going to buy a call because I think it's going to go here. Okay, maybe it does. But when you sell, you're saying that you're guaranteeing the other side of the trade. So if you sell the put, you're saying that you don't think it's going to go south. You think it's bullish, and you want to get paid a dividend, not a dividend, a premium. Just like your car insurance company, you pay them a fixed amount of money. In exchange, they guarantee the floor. You know, they guarantee your car, saying that if it has damage in it, they'll pay for it. They're hoping there's no damage. So if we sell a put, we're saying that we think the price is going bullish. So you got to remember, when we talk about selling premium, you got to completely flip your mind around about the way things work, because everything's backwards. So again, if this trade goes here, and it looks like it very well might, can get within this strike range right here, then he can sell a covered call, and that'll very likely bring him literally back to even. All right, Jeremy, so what is the plan if it drops further?
So if it drops further, I'll get a second chance to sell out of the money puts. Probably the 26 or 27 strike is where I'd be looking. And that just kind of takes me back to close enough to where the previous all-time, well, not all-time, but the most recent lower low than our current recent lower low.
Now, will you just be selling the premium to lock in premium, or are you willing to take the shares?
I'd be willing to take the shares at that point.
Okay.
And effectively, it does increase my long-term cost basis, but it has a good effect on my short-term cost basis. So I'm willing to take some not rob from Peter to pay Paul, but I'm willing to take advantage of a balanced position if it means in the long run I can make even more profit. So
let's talk about cost. Let me talk about cost basis real quick. If you, when you're in a trade, we talked a little bit about this earlier here when I talked about all this here. Let's say that I sold the 32 put for $1.50. That would mean that my cost basis is $30.50, which means that that's what it would cost me to have that stock. So because I subtract the premium from the strike, all right? Now that is true as long as you're in the trade. Now, the minute you are completely flat, now this is where you got to bear in mind, Jeremy calculates it a little bit differently, and it's fine as long as we all understand what's going on. If you sell the 32 for $1.50, your cost basis is $30.50 because you pocketed, but that would be break even.
Correct.
Now, if you ride this out to the very end or whatever, or close it at some percentage of profit, and as long as it's still above 32, you are in profit at this point because you pocket up to that $1.50, depending on whether you wait for it to expire and take the entire premium, or maybe you close it at 75% and you pocket maybe $100 or whatever and just wash your hands. At that point, you're flat. And in that strict technical basis, you have profit, but you have no cost basis because you have no position if you're totally flat. Jeremy, on the other hand, is working his profit against the price continually, whether he's in a trade or not. And that works for him as far as figuring out. So when he says that, my cost basis is $42, that is not saying, that's basically when you average all his trades and profits in and out, in and out, in and out, in and out, then it works out to be around $41, $42. But that does not mean that's what his current trade is worth. So it's a difference of opinion or take or whatever you want to call it there. It's neither right nor wrong. It's just a way to keep track of things, as far as accounting purposes, in your mind, as far as what your goals are and stuff. All right. Anybody got any questions about that? Okay, Jeremy, please do continue.
Sure thing. So one of the other parts of this is if you're monitoring trades based on profit, that's totally fine. But one should still be aware of what your break even is in the position. That's why I track it as in a cost basis position rather than just taking the current amount of profit away from my current average cost. It just makes it easier to keep track of that. So when I'm going to look for opportunity in short term to try and recover from being underwater, that's why I would choose the strategy I did. In fact, I think I'm going to put a limit order on those very quickly here. Another position, and I'll get into another position here so we can keep moving forward, because I'm only going to be able to do this for about another 10 minutes, unfortunately. Let's look at MSTU. And this one is a bit risky for most, but it's also a low cost position. And it wouldn't take long to get ahead of cost basis on this one. With this particular one, I was able to get in very, very near the bottom of that trend. I got in at $4.75 per share. And immediately I was able to knock that down to a cost basis of $3.25 within just a few trades. So if I was to enter it now, I'd be currently looking at an average somewhere between the current low and high. So if you look there, it's probably about $5.75 or close to $6. Just kind of looking at about halfway between the previous leg there.
Right now we're at 745-ish. Is that what you mean?
Yeah, so I'd be looking to sell for a cost basis. So like if I was looking to sell puts, I'd want to get probably about at least $1.40 premium for those puts. So let's
Okay.
have a look at the options chain on this to see where that would put us. The time frame in this is going to be the critical part. And this is where if you're entering a wheel trade position for the first time and it's something that is this volatile that can run away from you, it would be prudent to, rather than just acquire long shares at this point, to sell puts instead until you're eventually assigned. So we would probably be looking at about April 17th before we got any real premium that would get us close to that. And you can see the width of that is not very wide on the expected move. See the orange there. But if you look
So
at,
we go from 950 to 550-ish.
right, but if you look at selling the 650 strike, you get 65 cents, but just one strike closer or one strike further away, you can get 50 cents for the $6 strike. So,
All right. And notice here the delta is a 24, which means you've got approximately a 76% chance that you'll walk away and just keep this money. $50 that you'll just pocket $50. Now you got to sit in this trade until April 17, unless it starts moving quickly to the north. Notice here though, there's volume, there's open interest. That tells us that there's a lot of interest in this $6 strike.
yes, there is. So, it kind of pushes, it fluffs the premium up a little bit because I'm wondering what the IV difference is between the 650 and the $6 strike is with that kind of open interest. Open interest can have an effect on implied volatility.
Let me point one thing out.
Yeah, there's zero in a
This
650.
6.5. Now let me point something out real quick here because I know Jeremy's going to wind down here. See that zero open interest? Remember, if you sell to open, in order to get out of it, you have to buy to close. Okay. When you get to these open interest lines that have no numbers in them, it is much harder to get out of them. Very hard to get out of them.
Correct.
So unless you're willing to ride this to expiration, which is fine, if that's your strategy, that's fine. But if that is not your strategy, if you're thinking, well, I'll get in here and 65 cents, if it gets down to 10 cents, I'll close it. You're going to have a hard time closing it when there's zero open interest on it because nobody's interested in it. They're interested in the whole numbers.
And
Notice whole number, whole number, whole number.
there's some speculation, very little speculation in the day volume on there. You can see it's 26, but those guys are going to be holding bags. It's going to suck. So you don't want to play games with those guys. I'm sure the bid ask is a little bit wider too. If you look, current bid is 65 cents. Current ask is 75 cents. That's 10 cents wide versus an average of a 5 cent wide. The next strike is 50 to 55 cents. So ideally, you're going to have more volume there. This will end up causing a bit of slippage if you are going to go buy to close later on. But if you set a limit order and just if it doesn't get filled, you're not obligated to fill it. You can wait another day.
That's true.
Be willing to take time with this. That you don't have to have any sense of urgency with this because every day that goes by, you're going to be making the theta on this thing. And the theta is actually pretty decent in 2 weeks to expiration there, or 3 weeks to expiration there. So it's worth setting on. Plus, you're going to be pretty close to the low. I mean, your cost basis selling that $6 strike would be $5.50. That's not too bad.
Mm-hmm. Right. And a 76% chance of success that you'll just end up pocketing the money and not even taking the shares.
Correct. And then the call side, if you were to already have a long position and you were to sell this particular put today, as well as the call side, if you look at the $9 strike there, it's got lots of open interest and it's trading at 55 cents. So you get $1 and a nickel just for entering that. If you were long equity, even right now, it's what is it, $7 and 7.40 a trade share there, 7.36, whatever it may be. I can't quite see it.
Which one?
What's the current share price? 7.40. So
Oh, $7.40.
if
Yeah.
you're looking there and you realize that you can get $1.05 off of that, so your cost basis is going to be what, 6.35. And that's right out the gate. So if you were even to purchase shares today and then go and sell that put and that call, you'd be sitting pretty nice. You'd be down $1.05 just sitting through that, no matter what happens. The other bright side, a call and a put cannot both expire in the money. It can be one or the other, but it's never both. And odds are they'll end up both expiring out of the money in most cases, unless something's volatile. And this thing is volatile. So
Now, caveat here for those listening saying, well, I could buy a call and a put at the same time. If you buy that call, you better be holding 100 shares.
yeah, well,
You absolutely better be holding shares, because if you sell that $7 call and this thing goes up to $10, you got to pay $700. Excuse me. If you don't have those shares, you got to pay $1,000
yep.
to
Don't.
fill somebody's order at 700 because you insured that $7 strike.
Don't sell naked.
So we never, ever, ever sell something that we don't, either on the call side, you hold the shares, or on the put side, you hold the cash. You must have what if you're doing a call, hold the shares. If you're doing a put, hold the cash and allocate for it. Otherwise, margin call or massive hit to the bank account. At any rate.
Yeah, that could hurt. Said never trade naked. On the put side, same goes. Make sure you have the cash in the account to cover the position. You don't want to do this on margin. Okay, so moving on. I mean, you can get pretty good premium for this thing, and if you rotate to the next closest expiration, I think it's April 4th or April 11th.
11.
Okay, so in just a 5-day period, look at those same strikes. So the 9's down to 40 cents, and the 6 is down to 35 cents. So after a week, if the price goes nowhere, you can just buy to close those and roll them out again. So you don't have to worry about, being, within a week or two to expiration. With something like this, you can go 3, even 4 and 5 weeks to expiration if you choose. So you can be a lot wider with your expiration time in these. If you can also be a lot more patient, and still get some pretty decent performance out of something like this. I've done this with stocks that are at like $2 and own them for free within 6 weeks. I'm on course for this one. I go buy that. I have some puts open. I have some 350 strike puts open and open for 45 cents. They expire on the 4th. So if you want to go to the 4th, I could probably buy those back for a penny right now.
If you can get it. I don't have much success closing stuff at a penny. For me, it's 5 cents.
Yeah, that might be.
On Tasty, 5 cents to 10 cents is usually where I end up having to buy them back.
I might close it at 5 cents, but I mean, is it worth the 5 cent slippage to go and roll that out and sell another put? Well, yeah, it is now. Would it have been this morning? Probably not. I would have been probably able to close that at, I think the high of the day was like 22 or 25 cents or something like that.
Well, another thing to bear in mind too, let's just say, and here's some math for you folks. Let's say that you sold to open, just making up some numbers here. Let's say you sold to open at maybe 50 cents. If you can close it at 5 cents, that's a 95% capture, or 90% profit capture minus your commissions.
Correct.
And I'll talk more about that when I do my part. But and then you're flat, no risk of taking assignment on MSTU, kind of thing. So, and because this trade still has 11 days to go, and I've had that happen in a single day many times, that I can make 75, 80% profit in the same day. Close it out and walk away. Be done.
Yeah, I had one trade on this one so far that made me $1 in a day.
Yeah, absolutely. And one thing to realize is that some of the money that you may make in this wheel trading, if you're scalping, we'll just call it scalping, the wheel trade idea, looking for very, very short-term moves, 1, 2, 3 days, kind of thing. And that's lately what a lot of I've been doing, and I'll talk about that more later. But if you make $100, $150 a day, well, just remember, if you can do that consistently, $100 a day is $25,000 a year.
Yes, sir.
And that, and a lot of you, that may not replace your total income, but it would be impactful.
Absolutely. And
so
it's not without risk, of course, but something that's been beaten down this much. And this ETF offers just 2x leverage on it, and the premium out of the money is, horrendous. Anybody speculating on this by trying to buy to open options and then sell them to close for profit, for lack of a better way of saying it, is losing their ass on this thing if it doesn't move now.
Mm-hmm.
So this is great to take advantage of.
I'll be right back with you to go ahead and talk.
Sure. So effectively, when you find something like this, it's almost a rare duck. I mean, you can find stuff that'll give this kind of options liquidity, and there's pretty good open interest in this. There's pretty good volume in it. I mean, hell, look at that $6 strike volume on the put side and the call side. It's over 1,000 contracts today. Not bad. And to run something like this, you're looking at, if you bought it now, you'd be looking at about $1,400 to swing this correctly, with having the cash in the account to cover a put and 100 shares long to cover covered calls. But you can reduce the cost basis on that very rapidly in something like this. I mean, you can trade it day to day and capture some pretty serious premium on this thing. I've been a bit lazy with it myself. I could have taken advantage of many more swings in this thing, and I'm still doing very well with it. If you go and find something that can bring this kind of leverage to you, or that kind of amount of premium coming back to you versus cash outlay, break it down into a percentage, and you'll see why it's worth doing. So if you take, and let's say, just to keep the math a little simpler, let's say you took a position at $5 on this, and in a month you took in, let's say $2.50 worth of premium. That's a 50% monthly return.
Yeah, absolutely. That's incredible.
So when you do the math on something like this, I like to lay it out as, okay, if I'm looking just a couple, 3 strikes out from the money from my entry, what kind of percentage am I going to potentially get for my outlay? So when I say natural monthly yield, that's what I look at. I look at how much can I make in a month on this thing.
Let me see if they've got percentage of profit in here. I don't know if they do, because I normally look at that on Thinkorswim.
I'm not sure Tasty does. I know they have a way to
return on risk. There it is.
Yeah.
So return on risk is, if it's $5 with a 50% return, that would be $2.50. That is basically saying, now, of course, we'd never tell anybody to go all in. But that would mean that, if you had $10,000 and you went in on this and this played out, you would be at if you had $10,000, you'd be at $15,000, because you'd make 50% of your money, kind of thing there. But it's, and those are always amazingly sweet when you can get them. But generally, most of them are going to be, 10% or less.
Typically,
but yeah, that's a great observation. Absolutely great observation.
So even if you end up upside down in the front couple weeks on this thing, as long as Bitcoin's active, MSTR is going to be pretty active in price action comparison. and you're putting leverage on it with this, yes, it is a bit risky. This can go to zero. But if you stand to completely be at a zero cost basis within about, and this is out to April 4 at 50%. If you went out a month, say to the middle of, towards the end of April there, and did the same calculation for percentage ROR.
The monthly or the end of month?
Probably end of month, like a fiscal month, whatever. Yeah, you're looking at
53%.
Not much more. So if you swing the 2-week expiration twice, you've made 100%. And theoretically, inside of a month, you could be at a zero cost basis on this. So I'm definitely interested in this one. This is my bread and butter right here. I love these high volatility, high yield type of options plays.
There is an actual trade set up where you can just simply say, I'll just buy 100 shares right now, and it'll cost me $7.50, and I'll sell the actually, I'm going the wrong way here, but if you bought the stock right now, you can immediately sell the premium against it just to get your cost basis immediately down. In other words, say you bought 100 shares, you'd spend $750 right here and immediately sell a covered call against it. Your price would be about $6.35, even though you bought it at $7.50. No, wait, $6.50 minus a little bit. You can actually, you're in this trade though, however, as long as it stays bearish on you, you can pocket all that money and just rinse and repeat. You can immediately go to a covered call side if you wanted to. You could obviously do that immediately.
I could even do
Realize
both.
too that remember here, part of the option is delta and is the addition. So if you buy the $7 versus the $6, you will generally see that the whole number part should go up roughly, and we call that the extrinsic, excuse me. The extrinsic should follow. So $7 to $4 plus $3 is $7. $7 to $3 plus $4 is $7. Y'all see that? That's called extrinsic value. And that is part of what theta kills over time as you're in that trade. So anyway.
Yes, sir. Theta pays you, but extrinsic value is your focus. So if you're thinking about it, you're trying to get as much yield as fast as you can without putting yourself in a huge risk position. This checks all the boxes.
Actually, I said that backwards. This is intrinsic.
Right. Intrinsic value.
Intrinsic. Excuse me. I'm sorry.
The extrinsic is the dark shaded.
Is the premium part? Yeah.
So last one I'll leave you with, and then I got to get on a call with my wife. She's had some sort of something urgent to talk about. I think she might have sprained her ankle or something. So she's down in Georgia right now. Let me get one last thing. NVDX is another position I'm in, and if you want to keep the same percentage on that, go to look like April 4 expiration. This one might actually be a lot less risk. We know NVIDIA isn't going to go bankrupt overnight. MSTR, who the hell knows? Bitcoin can be a pretty mean mistress, and
absolutely
it is attached to it like no other. So NVDX would be a better play for safety. And it's not much more than taking a position on with MSTU currently. So looking at the percentage return, though, it isn't going to be as much bang for your buck, but it won't be bad. And if you've got time to wheel this thing, this would be the more you would learn a lot in a short amount of time with MSTU. But this would give you more time to be patient and just calm yourself. So in reality, this is the way to go if you're going to start with cash, something like this, or even something that's direct to equity if you prefer, up to you. This just gives you an opportunity to do it for a lot less cash outlay. So for a beginner, this would be a little bit more friendly to the I guess you could say friendly to your cardiac health
Yeah, yeah.
comparatively. Because you could be a little underwater with this and still be patient with it and know that NVIDIA is not going to be delisted overnight
Yeah.
versus MSTU. However, MSTU is going to teach you the process very, very rapidly. So if you are a beginner, that wouldn't be for the faint of heart because it's going to move very, very fast. However, do it on paper and you will learn the process very quickly. It will make a lot more sense to you to do that. So if you're, depending on where you're at, if you're an absolute beginner with this strategy, do it on paper, go with MSTU. If you are somewhat reasonably good at trading options, or at least understanding how they work and what they do and how to trade them in a buy to open and sell to close environment, this is the opposite. You sell to open and buy to close here, or take assignment. The second person in that tier of experience would probably rather start with something like this. If it's their first time trying a wheel trade and they've got some experience with options, this would be the way to go. So in this one, yes, the percentage isn't great, but pretty much anything better than 8% a month is
Well,
going
a
to
month.
kick
Yeah.
ass. Compare that to the S&P performance, and you're going to be right up there with trading with Warren Buffett. Only you're not going to have to sweat as much as far as
Yeah.
return on dollar.
Well, the other thing about it though too is, I do a lot of trades. This is not a good example here because we've got a lot of sporadic jumping around here in the return of risk. But everybody wants to compare themselves to the S&P and whether they're going to beat it or not, or this or that. In the end, you don't have to compete with the S&P. I do not. I'm just competing with myself. And what I mean by that is, let's say that I could get my portfolio to go up 20%. Say the S&P goes up 65%. Well, but if I can get 20% a year consistent, we know that the S&P goes up 25%, down 10%, up 16. The S&P does have some roller coasterish effect year over year, year to year. But if you can manage your own wheel trades, and let's just say you get a consistent 15% a year, I think you'll still beat the S&P overall, or maybe, but the point being is, are you happy and hitting your goals if you make, say, 15% a year? If 15%, if you invested in stocks and you got year after year 15%, I'm not going to complain with that. Yeah, I would love these 25. I'd love to get 25 to 50% year over year. And with the wheel trade, yes, you can do that, no question. But the point being is that you're in control here. The problem with throwing your money into the SPY and the Qs is other people are in control of it. And like right now, if you were long the Qs or the SPY, well, you're in the whole 10%, 15% if you're in the Qs, something like that. You're like, oh, I've been down like that there. But when you are doing your own trades, whether you buy your own stocks or whether you trade the wheel or whether whatever it is, you're the one in control. Now, depends on how technically adept you are with it and stuff like that, risk management. And that's why we've got the forum here with all the moderators, that when you're not sure about a trade. But I would rather see consistent daily or weekly profits than I would be competing with the S&P.
I hate to interrupt. I got to get on the phone with my wife. I'm going to leave this with you if you don't mind. I'll keep
Yeah.
it recording and sending to YouTube, and I can just edit the end of the video off later.
That'll be fine.
Just
That'll be fine.
if you wouldn't mind shooting me a timestamp, I got to get on the phone. Sorry, guys.
Okay, will do.
Thanks.
All right.
Bye.
Thank you. Enjoyed that. Bye. All right. So let's talk about, I'm going to tell you how I trade the wheel. And I am a very basic wheel trader. There's only two things that I'm going to do. I'm going to trade the most basic wheel strategy, or I'm going to sell cash secured puts with the hope of taking profit on them. For example, this morning I did a cash secured put on Dollar Tree expiring March the 28th at the 55 strike. And let's find that. It's right here. So it's this week's expiration. What is it? DRT? BT? No. DLTR. Daggone it. Okay. There we are. And I have this position on right here. I am short. I bought it at 52 cents. Or excuse me, I sold it at for 52 cents, so which means I got the premium. I got 52 bucks offhand. Right now, I am at 17% profit on it, which is a whopping $9. So it's not a lot of money. By any means, it's not a lot of money. But today's actually been one of my slower days because normally I would have 6 to 7 trades open, and I'd probably make $90 to $150 a day doing this. Today is a bad one, or was a bad one this morning. I haven't looked this afternoon. So let's take a look at how I trade the wheel. And this is looking at it from a very basic way. First thing I want to do, I want to find a list of stocks that are stable. And I run these through a scanner over on Thinkorswim and all that. But I want to find a list of stocks that are reasonably stable within the year and the last, 3 years, as far as, no major drawdowns and all that kind of stuff. That have, they have minimal market cap, they have a minimal daily volume and all that kind of stuff there. These are not penny stocks and that kind of stuff. Now, looking at the prices, let's just go look at some prices. One of the challenges with getting into the wheel trade is the fact that you got to have some cash. So let's just look here. AG, you'd need about $700, $745. So here we're getting close to having $1,000, because remember, you're talking about 100 shares. So $9.87 becomes $988 in your account to trade. So there are things that you can trade depending on what your tolerance is. Now, Jeremy trades about 2 to 3 tickers at a time. I like a little bit more diversity or possibilities in here. So we kind of want to be, that's totally up to you. Jeremy focuses on about 2 to 3, 4. I've got a tree of places to go hunt. Now, the next thing that we need is we want to find some high implied volatility. And on Tasty Trade, they call this their IV rank. What are we talking about here? We're talking about, if I go to the trade tab, we're talking about these numbers over here. This implied volatility, telling me that this thing goes all over the board. Here it shows plus or minus $8.70, which is more than 10% of the value. The value of the stock is $70. 10% would be $7. This thing moves more than 10% is the expectation this week. This week, we're expecting that this thing can move a lot. So I like high implied volatility. Why do I like high implied volatility? Because remember, the higher the implied volatility, the higher the cost or the value of the options. Those two things, when you are looking at the beginning of a trade, not when it's ongoing, but at the beginning, the higher the implied volatility, the higher the price of the options. Okay. So, and let's just take a very good look at this here. Let's just go to, let me see if I can find, let's go to a low volatility instrument like, and see if I can find, okay, Marvell and TIGR. I'm looking for two that are kind of close in price. Okay, let's compare TGTX. Let's look at this week at the money, 85 cents versus Nugget at $1.20. Yeah, that wasn't a good comparison. The point I'm trying to make here is that let's say you find two tickers that have the exact same price, stock price. The one with the higher implied volatility, their options will be higher, will be bigger numbers. So you got to remember that. The higher the implied volatility, the more the options are. If we're selling an option, then we want the biggest numbers we can get because we want to put as much money in our pocket as we can. So here's the way that I trade. I'm going to go down my little list here. We'll just take TSLL. Ironclad was throwing that in the chat. Let's go to this week's expiration. All right, remember this is the expected move here in the orange. Here's the standard deviation. Let's turn this return on risk back over to delta. All right. Let's say that I wanted to do somewhere around a delta 10, meaning only 10% chance I'll get assigned. And I'm going to come over here and I'm going to look under the bid column to see how much premium are they willing to pay me. $11. Now, that's $11. So it's a 1% return. We can move this, tell you what, let's move this volume to return on risk. So that's 1%. So if I were to sell this, let's say I had a, whatever, let's say that because of my account restrictions or whatever, my trading rules, I'm only willing to buy one. I'm only willing to tie up $1,100 into this TSLL. All right. Then I would make a 1% return on my money if this thing over time goes to zero. There's only roughly a 10% chance that I could get assigned. It's not saying it won't happen. I mean, granted, you trade 10 to 20 different contracts a day at 10% each. One of them is going to get hit if you let them ride, one or two of them. So, nonetheless, let's say that per week, let's say I sold it at 11 cents and I'm able to close it at 5 cents. You'd say, well, that's $6. All right. Now I know we're not talking about a lot of money here. If you got bigger accounts, you can buy multiple contracts and all that kind of stuff. But there's also a lot of people that we know out here that the biggest their account may be maybe $5,000, and that's okay. There's nothing wrong with that. But watch. Let's say that at 122%, 1.22%. So if I bought it at, say I could sell it at 5, buy it at 11, that means I made 45%. Wait, actually I made 50, we'll just call it 50% profit. 50% profit at a 1.22% means I made a 0.61%. Well, and I don't remember the compounding formula at the moment. However, that's utilizing $1,000. If I made 0.61% times 250 trading days, actually would be more because I haven't compounded it, but that would be a lot more percentage wise. So the point I'm trying to make is, and let's just say, let me do this in a spreadsheet. Give me 1 second. Let's just say that I made 0.6 percent. Well, dadgummit, where is it? Percent. 0.6. Let's try that. And let's say that I have $5,000. Well, my profit on that times open 1 plus that would be $30. Okay. Now, equals that times, let's just say I can continue to make this 6% every day. Obviously, that's ridiculous. But the point is, and there's only 200 days there, you took a couple of days off for vacation. If I was making that kind of money, I can guarantee you I'd be taking vacation. The point being is that, and I've got something wrong in my formula. I've got to have something wrong in my formula. No, it's actually right. Anyway, oh. I know what I made wrong. There's another 0 in here. That's why. Sorry. Okay, there's a little more realistically. Okay, I knew something was wrong. I was going up 60% or 6%, not 0.06%. The point being is that you could take a $5,000 account and hit around $17,000 a year. $17,000 in 1 year if you can make 0.6% a day. Now that's 100% reinvestment and everything like that. That's not realistic. So we're going to shave, at least half of it off, and maybe, or whatever. So 17, 18, it would be 9,000. So if you could take 5,000 and go to 9,000 in 1 year, that's an 80% increase on your money. Tell me that's not a good idea. Tell me that's not a great idea. But even if you can't do that every day. So the point being is that, now we do have commissions we have to take out. That's going to eat into some of it. So, whatever. The point is that the wheel is a slow but steady incomer. Slow but steady incomer. It's not a lot per day, but it's slow and steady. And if you stay with it daily, then you make money. Now, this is where Jeremy and I differ, and I'm not saying that I'm right or he's right. Neither one of us is right or wrong. It's our difference in trading opinions. I like low deltas because, and I'll take less premium for that. Yes, I'll take less premium because I want shorter trades with lower risk of assignment. Why? Well, Trumponomics. I'm not trying to get political. I'm not saying that Trumponomics are good or bad. That's no statement there about that. It means, though, that right now the markets are very chaotic. And because the markets are very chaotic, and I'm not sure about how deep these pullbacks are going to go on the major indices, that I'm not so sure. There's very few stocks I would willing to to put into my long-term portfolio of any kind. I don't want to do that right now. Had this been a year ago, I would have probably gone down here at the 9.5, taken this, maybe even the 10, and been willing to ride it. But right now, with all, maybe a 20% risk, but right now I'm taking a 10% risk. And if it gets close to it, I'm closing it. And I'm just putting money in my pocket instead of even running the risk of getting assigned. And if a stock starts to turn against me and I start going and it's going the wrong way, then I'll take the loss on the puts instead of taking the assignment. And just close out my contract and take a loss on the option instead of taking the puts. That's me for right now. Now, so what do we see? Let's just kind of go down the list. TSLL. Right here is the expected move. Let me zoom in on that. Right there, that orange bar is the expected move. This is the standard deviation line. So as long as I'm out here in the outer margins, I feel reasonably safe. And in fact, the delta right here is about 10%. It's .11. Don't care that it's minus. Don't care about the sign, just the number, .11. Which means right now I've got an 89% chance that if I took this trade, that I would end up pocketing the money. Now, what's the rest of the criteria? The next part of the criteria is to look at my risk on return and make sure that it's at least 0.5%. Why 0.5%? Because I am 1 week. If it's more than a week, I want more. But look at it this way. If you get, so let's look at it in 2-week increments. How many 2-week increments are in a year? 26. If I get 1% every 2 weeks, then my account has grown by a minimum of 26% for the year. Again, not bad at all. If you had $5,000, you'd be at what, 6,200 at the end of the year. And you say, well, that's not a lot. Or no, what did I say? Sorry, 25. Yeah. You'd be at $6,200. Well, that ain't that great, but remember, I'm not factoring in compounding effect. As your account grows, you've got more money to put in it, and so it would probably be closer to $7,000, $8,000, and which is not a bad return on a $5,000 account. So for me, I want at least about 1% every 2 weeks just to get growth, and my safety margin is there. I've only got a 10% chance roughly of having to take assignment on this. So not a bad bet. Third thing, let's look at the open interest. Here I see open interest. If I don't see any open interest there of at least 10 times the number of contracts I'm going to buy, this would take me $1,100 to buy this stock. So let's say I got a larger account and I'm willing to take 3 contracts. So $3,300. I'm willing to sink $3,300 into this. All right. 3 contracts. The key that I want to say here is that we need to see volume and open interest of at least 30 times the number of contracts. So if I'm thinking 3 contracts, I want to see at least 100 open interest. And I definitely want to see some volume in there. The problem with volume, of course, depends on what time of day you sit down, because volume is cumulative throughout the day. If you're at the end of the day, then yeah, I still want to see a lot of volume there too. Because if I want to close this contract out as it gets close to profit, somebody's got to be on the other side of this. I mean, obviously the market makers are on the other side of this, but the point being is, if you see some big ass zeros over here, there's a very good chance you're going to get stuck in this trade, and you're just going to have to ride it out to expiration. Or you'll have to really take a haircut. If you say, well, I want to get, I want to drop from, say 17 cents down to 3 cents. But if there was 0 interest over here, you may have to take it at 6 to 8 cents. And you say, well, I only got 50% instead of whatever. Because there was nobody willing to take my trade. If you make a trade attractive enough, yeah, even a 0, somebody will step in and take it. But we don't want to pin ourselves in that position. So always check the open interest. The risk on return is totally up to you on that there. I do look at it, but my thing is, for me, I'm looking at this bid and sell. Now, why is that interesting there? Well, like in my case, I'm on Tasty Trade. How much does Tasty charge for an option? $1. That means that if I buy this at 11 cents, that's going to be $11 profit they're going to give me, minus $1 for the commission, minus regulatory fees. So I'm actually going to make $9.75 or whatever it is. Well, $9.75, let's say, means that I lost about 11% of my profit just in fees. So when I'm scanning through, I want to find trades where I'm going to find at least 15 cents or more. So there's no trade for me here on the 4-day. Let's go take a look at MSTU. The 4-day trade. No money. Now, the other thing I haven't mentioned here, of course, is ultimately we'll look at the charts too. Now, I'm just looking at these upcoming Friday expirations. Hims and hers. Look at this. Let's see. Let's first go to this 10% probability. Here's 22 cents. This looks good. This looks good. This return on risk, at least it's at least 0.5. We've got some open interest. Let's go look at the chart. And I don't know what's going on with this. Let me jump here. Let me drag this over. Whatever. Oh, 5 days. That's why. Let's go look at 1 year, 1 day. Okay. Hims, where's the median right here? The median, look at this this middle area right here as I'm moving my mouse back and forth through. Here's this medium area. We jumped out of it. We're coming back into the box. Let's zoom in here. What do I see here? We hit the lower regression. We've now hit the higher regression. Now, one of two things is going to happen here. Of course, the TTM squeeze or MACDs, whatever you want to use. This is showing that we do have started a bullish trend. We do have a DeMark sequence here. 1 on the upside, 2 on the upside. 2 took out the 1. That's the beginning of a good DeMark sequence. So that kind of tells me bullish. Not to say that it won't, but who knows? Where's the floor for this whole thing? Well, let's just go with this midline. which is somewhere here around, and you guys can't see that on the right, I doubt, but it's around 28, around 28.5. Because I know it's kind of scrunched up. So, well, 28.5 is way back here. This is my expected move. So, what are we looking at here? If I want a 10% odds, 22% is not bad. Let's see if we can put this trade on. So notice, it's outside of the expected range. It's around the standard deviation. It's only got a 10% or 11% chance of assignment. So that's not bad. And which line do I like? 33 or 33.5? Well, there's more open interest in the 33. So let's go to that. The current bid is at 22. The ask is at 25. I'm going to try and hit the middle, which is 23 cents. For me, I would take 2 of these. Now you can do this, you don't have to do this. Now notice here on Tasty Trade, percentage of profit, 87%. The chance of getting 50% of my money out of this, 76%, meaning that it'll go down to around 12 cents. So that looks good. Tasty and others, you can put a bracket on it. So I'm saying I'll take a stop loss if it goes against me 100%. So if I get in at 23 and it goes down to 46, I want out because it's going against me. Maybe I will, maybe I won't. I'll go ahead and leave it on just for demonstration. And this is my take profit here at 2%, 2 cents. I'm going to raise it to 5. All right. So I've actually got an OCO, one cancels the other, wrapping this up. I've got a stop and I've got to take profit on it. And I can adjust this after the fact. This will just put it on the board. Let's see if I can get it because I'm going for the mid price. And it'll show up over here with a pop-up window if and when it hits. Now, if I go look at my positions, you can see it's got 5 entries on it. This is where it is, and this is that's my stop. That's my take profit. Those don't take effect until this last line right here. It shows that the midpoint is actually moved down to 22 cents. I said I'm not willing to pay more than, or I want at least 23. I want at least 23 cents. It's saying 22. I'm going to let it soak for a minute. But you know what? I forgot totally, or no, it didn't. There it is. It's hit. So I'm going to turn the working orders off so that we just see my raw positions. Now, HIMS has actually gone in the hole. Remember, I've got $1 and some odd in commissions here. So Dollar Tree, I put on this morning. It's stuck here at about 25%. Nobody's trading it that much right now. Why? Earnings on the 26th, which is Wednesday. I may just go ahead and close this one out today and just call it a day. Although, I don't know, we'll see. If I wait till tomorrow and all things are equal, at least Theta will chop this down a little bit more. And I'll make a little bit more money if all things stay equal between now and tomorrow. But let's look at when that trade actually is. Do they actually tell us? Oh, let's go ask AI. DLTR. Where's Grok? Oh. At what time and day are the earnings? If I could spell, it would help. Is it before market, after market? Dollar Tree is scheduled to release its earnings on the fourth quarter, Wednesday, March the 26th, before the market opens. So probably about 8 o'clock Wednesday morning. So that means that I need to be out of this trade on Dollar Tree sometime tomorrow. And that's fine. Okay. HIMS, as you can see, HIMS is already starting to move up. Now, in my case, when HIMS gets up to about 25 to 30% profit, I will move my stop to break even. I'll start moving it up a little bit there. There's it depends on how wild the swing is. Let's just take a look at that here. If I go over to the trade table, here's my trade. Oh, that's Dollar Tree. HIMS. If I right click here, view the option in the chart. Now, this is not the stock chart. This is the options chart, a chart of the options. And we can see, oh yeah, this is on a daily. Let's bring this on down. Oops, come on. Like I said, Tasty's not that great for charting. Here we are. Oops, that's not what I wanted. I wanted that and this. Okay. This is my order right here. And you can see it went down a little bit. That's okay. My stop is way down here. And I'm willing to take 100% loss on this trade, meaning I bought it for 23, and 100% loss is losing 23, which means I got to give back my 23 and lose another 23. So because I got 23 in pocket right now, whatever. It moves from, the option moves from 23 cents to 46 cents is what I'm trying to say. I said that wrong. Okay. Oh, excuse me, that's the wrong side. Here's my stop up here. What I want to see is this option just plummet down to zero. That's what I want to see. If the option turns around and goes north, here's my stop. Dadgummit, are up here. I got to set everything backwards. Again, you got to remember when you're doing cash secured puts, everything, or when you're selling to open, everything is backwards from what you think. So HIMS is hauling around, or him hauling around, or however they say it. It has an 89% chance of profit, and we're going to let it soak for a little bit. Let's go back to the rest of our list. And if you guys got any questions, you can drop them in the chat, or you can jump on mic at any time. But again, this is my strategy right now because of Trumponomics. Eventually, Trumponomics will settle down. When they settle down, I'll be willing to take some positions and hold them. But right now, I'm just not feeling it. Now, some of our things like Soxal, SMCI, these are ETFs, and they're more volatile because they're, Soxal is an ETF. It's leveraged also, which means it moves faster. SMCI tech has really kind of been in the gutter a lot lately, so we want to be careful of that. Let's take a look at Soxal. If I go for this Delta 10 here, it pays $12. No, just not enough money. Let's take a look at SMCI. Now, bear in mind, I'm looking at Friday's expiration, but quite frankly, starting tomorrow, maybe Wednesday, I will be too close to it. I can only do this because it's Monday. After this, though, there will not be any money in these trades because we'll be too close to expiration, and I'll have to run out to the next expiration to get any money in them. So we're looking at SMCI. Here's the expected move. Here's the standard deviation. Somewhere around in here. Look at that. Okay, look at that volume right there. That looks pretty good. That's the 37 strike. Let's go look at the chart. Let's put you on the 4-hour. Okay. Right here where my mouse is the 37 strike. And we're going to need to go back further. Okay. My lowest point here, yeah, that's fine, is going to be here, which is going to be the 33.5-ish. The question is, do we have a chance of coming where do we think we could go? Now let's take a look at the chart. And what does the chart tell us? The chart tells us that, and I want to move to the daily now because I want to use my indicators. The chart tells me that I'm above linear regression. I'm above the 20 moving day average, which is the middle study on the Bollinger Bands. It's 20-day exponential, or you can do simple. It's up to you. Now, but we're kind of seeing around, what was that trade we were looking at? We were looking at around plus or minus the 37. So that puts us right about here. Let's zoom in on that. Right about there. Notice this right here, this consolidation. Now that's going to be a magnet zone. So to be quite honest, do I want to take a put here headed towards that? Not really, because we're on the wrong side. If I was down, we're above the 20 Bollinger Band average. We're above the middle of the linear regression. And what do we know about linear regressions? Well, they have a tendency to oscillate, which means that there's a very good chance it could come back down. Now, on the bullish side, we have a DeMark sequence that is positive. 1 goes to 2. 2 has taken out 1 barely and retreated. So I'll be honest, I don't have a strong enough argument to assume that SMCI is going to continue bullish. So I'm going to take a pass on it. Yen is a Chinese ETF. Let's take a look, see if there's anything. Again, remember, starting probably tomorrow, I will have to move to the next expiration because it'll just be, there won't be any money in this. Look at this, though. Good. Googla moogla. This is NASA money. NASA money. Yen, expected price move $3.50 from the at the money, or, any rate. So well outside of the expected range. And even coming out this borderline here, the standard deviation. Wow, that looks really good. 40 looks awesome. Let's go look. It's got open interest. It's got a nice, that's 90%, or not 90%, not quite 1% for 4 days. For 4 days, that's nice. Let's go look at the chart here around the 40. See how that looks. We're on the daily. All right, we got a big gap down. Yen looks like it gaps and moves around a lot. Lately anyway, it gapped up, it came back down to close this gap. Now it's gapped, then it gapped up again. It came down to close the gap. We're talking about the 40. And the question I ask is, what do we see? Oh, phooey, the market's just closed on me. I didn't get my trade in. Okay, well, we'll have to do it tomorrow. Okay, so yen. It's at the bottom of the standard deviation channel. I like that. I like that a lot because if it wanders between this channel and it's at the bottom, there's a very good chance. Where's it going? North. There's also the fact that it's just barely, it's right, just barely below the Bollinger Band 20. You don't have to use Bollinger Bands necessarily. I don't use them normally for this, but I just had them on for something else and left them on. But it's close to center, and that's fine. That's fine. Now, you could say if you're playing the Bollinger Band strategy that it would come off one and it comes back to mean. But just because it comes back to mean does not mean it goes south. It just means that it will come back to the average, and that's exactly what it has done. You can see here, went up, average, went up, average, went up, average. Okay. The TTM squeeze, though, kind of indicates that it may be wanting to go south. Now, you guys cannot see that unless I zoom really in on this. It is in a negative DeMark sequence. There's the -1, the -2. 3 has not taken out 4. That's encouraging, though, and it may break because you see over here it went 1, 2, 3, and then the sequence broke. Darn. I wish I'd have got my trade on today, but at any rate, I was going to take this. Anyway, does anybody have any questions here? So let me just feel free as I wind this down. It is 4 o'clock. I hate to hold people too terribly long. But again, right now, because of Trumponomics, I am not holding anything very long at all. So I am simply collecting premium by cash secured puts. And so when we take a look here, we can kind of see, okay, my HIMS position is down a little bit. That's fine. But remember, overnight, theta is going to trim at this. And so all things being equal, I won't be down 13% tomorrow morning because theta would have chopped into it overnight. And so the longer this goes, the more theta eats at it. And 23, 22, let's see, where is it now? It's at 26. So maybe it'll be 24, 25 tomorrow, something like that. Who knows when the market opens. So anyway, overall, I'm at plus $10 for the day on this. Yes, I do take a lot bigger positions and stuff like that. I just didn't have anything this morning that I had put on other than this Dollar Tree. Dollar Tree looks like it closed at 30% profit. Not bad, $16. Remember, pennies make nickels, which make dimes, which make quarters, which make dollars. So is it, do I have bigger accounts? Yes, I have bigger accounts. Do I make bigger trades? Yes, I make bigger trades. Do I need to right now? Why am I taking these smaller size trades? Trumponomics. I don't know what's going to happen. I don't know what's going to happen. When markets get back to a little bit more stable, then yes, I will put on bigger trades, more size and stuff like that, and I won't skip a beat to do it, but not right now. Anyway, any questions here? I'm winding down. 3, 2, 1. All right, folks, enjoyed it. I hope y'all got something out of it, and we will see y'all later there. If you have any tickers that you want to look at, when we do this Wheel Club thing idea, we want you guys to say, well, I'm looking at XPEV, or I'm looking at Palantir, or I'm looking at Dollar Tree. What do you think? Throw it up to us. Let us look at it. Let's see if we can find something there. Especially if you're new, we can help refine the process. Now, again, like I said, Jeremy and I are both wheel trading, except the difference being is that I'm hesitant to actually take ownership of the stock right now for, probably a couple more weeks or a month. Remember April 2nd, first week of April in general, there's going to be a lot of chaos because that's when all the Trump tariffs are supposed to finalize unless he rolls them again for some reason. So the first week of April, be on guard. That's another reason that, I don't want to hold a lot of stuff there because I don't know what's going to happen. Jeremy's willing to take more heat than I am, and that's fine. I'm not. So, I'm taking profit instead of taking stock right now. Both work. It's fine. That being the case, like I say, look around your chart, see what you think, see what you like. And if you see something you like, something you want us to chime in on it, just let us know and we'll talk about it. With that, this is Marziti signing off. And let me send Jeremy the message that we are ending at 4:06 p.m. See you guys later. Thanks. Bye.